In India right now, receivables make up roughly 1/3 of the current assets for businesses.
Yeah, which is just a staggering statistic when you really stop and think about it.
Right. I mean, just think about the gravity of that for a second. 1/3 of corporate short-term wealth is not sitting in a bank account.
No, definitely not.
And it's not sitting on a warehouse shelf either. It's just, floating out there in the ether in the form of unpaid invoices.
Waiting to be collected.
Exactly. The capital tied up in those promises is almost equal to a company's cash and inventory combined.
And I think that completely shatters the illusion we often have about revenue,
Oh, totally. We see this massive sales number on an income statement, and we just assume, well, the company is flush with cash.
Right, but the reality of corporate finance is a whole lot more precarious.
Okay.
I mean, a sale is really just a theoretical concept until the cash actually clears the bank.
Yep.
Until then, you're basically functioning as an unsecured lender to your own customers.
Which is wild. So welcome to the deep dive. We are speaking directly to you today, the MBA student, the future financial manager, the corporate strategist.
The ones who are going to be making these calls.
Exactly. Our mission here is to take you far beyond just, memorizing terms to pass an exam. We are tearing into this incredibly detailed academic text purely focused on receivable management.
Specifically looking at Chapter 17 of our source material today.
Yeah, we're going to decode the actual mechanics of how businesses manage the money they're owed. We want to make sure that every framework, every hidden cost, every strategy we dissect today just becomes second nature to you.
So that when you are eventually sitting in that boardroom, staring down a cash flow crisis, you know exactly which levers to pull.
Because treating trade credit as just this standard operating procedure, doing it just because everyone else in the industry does it, that is a massive vulnerability.
Oh, absolutely. You can be a really powerful engine for market dominance if you manage it correctly, but it can also quietly bankrupt a company that's otherwise experiencing record-breaking sales.
Okay, so let's unpack this. Let's establish the foundation before we get into the really complex mechanics. When we say accounts receivable in this specific context, we're talking about the trade credit economy.
Right, the B2B world.
Yeah. The source material brings in this definition from Robert Anthony, and he specifies that these are amounts owed to the business enterprise, usually by customers.
And he makes a really deliberate point there to separate trade accounts receivable from other types of debt.
Like what? Like an advance to an employee?
Exactly, or maybe a loan to a subsidiary. That distinction matters because trade credit is fundamentally, it's a marketing and sales instrument.
Right, it's not just a finance thing.
No, not at all. In the B2B world, immediate cash settlement is incredibly rare. I mean, think about it. If a massive electronics manufacturer demanded cash up front from a global retail chain, what happens?
The retailer would probably slash their order sizes.
Exactly. Because they haven't actually sold those televisions to the end consumers yet. They don't have the cash.
So trade credit essentially bridges that gap. It mobilizes the goods from production to distribution.
Right. You are extending credit to sort of lubricate the supply chain and secure your own market share in the process.
But, and this is the big but, providing that lubrication is expensive. And this is where I see a lot of early-stage founders and even some seasoned executives just completely miss the mark.
They view extending 30-day or 60-day terms as a free courtesy.
Yes. Like it doesn't cost them anything.
Yeah.
But our source text absolutely shatters that misconception. It breaks down 5 distinct costs associated with maintaining receivables.
And they are crucial to understand.
So let's really analyze these. Let's start with the first one, which is opportunity cost. Like if I'm holding $10 million in receivables, what is the actual friction there?
Well, the friction is the time value of money, right?
Yeah.
And your company's weighted average cost of capital. That $10 million is effectively frozen.
Stuck in limbo.
Yeah. If those sales had been settled in cash today, what could the firm have done with that capital?
They could have aggressively funded some new R&D initiative, maybe outpaced a competitor.
Exactly. Or purchased new manufacturing equipment to lower their unit costs. Or, at the very least, they could have placed those funds in a high-yield corporate vehicle and just earned interest.
So the yield that you forfeit while you wait for your customer to pay that is your opportunity cost.
Right. It's basically an invisible tax on your profitability.
Man, that's a great way to put it. Okay, that leads us directly into the second burden, which is administrative cost. I always find this one fascinating because it's kind of buried in operating expenses,
Oh, completely.
Yeah.
People assume the cost of credit is just the financial math. but there is a massive physical infrastructure required to support it.
Like you can't just issue an invoice and hope for the best.
No, you need enterprise resource planning software to track the aging of these invoices. You need an entire credit department.
Right, analysts to vet the customers initially.
Clerks to reconcile the payments when they finally do arrive. And, personnel to actually chase down the late payers.
So you're paying salaries, you're paying software licenses, administrative overhead, all solely because you don't demand cash up front.
Exactly. If a company suddenly transitioned to stricter terms or cash on delivery, those administrative costs would just plummet.
That makes total sense. But then we hit the real nightmare scenario, right? The third cost, bad debt losses.
Yeah, this is the painful one.
You vet the customer, you extend the credit, you wait the 60 days, and then poof, the customer files for bankruptcy. Or they just disappear.
And that is the ultimate risk of functioning as a lender. When a customer defaults, the damage to your business is, well, it's multifaceted.
You haven't just lost the profit margin on that sale, right?
You've lost the physical cost of the goods sold. You've lost the labor used to produce them. And like we just talked about, all that administrative cost you spent trying to collect the debt.
Wow. So a significant bad debt write-off can instantly erase the net income from, dozens of other successful paying clients.
Easily. It wipes out so much hard work.
Which makes the fourth cost even more painful, if you can believe it, financing costs. Because while you're waiting those 60 days to get paid or realizing you might never get paid, your own obligations do not pause.
They absolutely do not. Your payroll is still due every 2 weeks. Your suppliers demand their cash. Your warehouse lease has to be paid on the first of the month.
So if your operating capital is locked up in your customers' accounts payable departments, you have to find liquidity somewhere else.
Right. You draw down on your revolving credit facility, you take out short-term commercial loans, and guess what? The bank charges you interest for that privilege.
So the size of your receivables directly dictates the size of your financing costs.
Exactly.
Yeah.
You are literally paying interest to a bank so that your customers can take their sweet time paying you.
That is such a brutal reality check. Okay, now here is the fifth cost, and I really want to spend a minute here because it often confuses people who are studying corporate finance for the first time.
Yeah, this one is counterintuitive.
The source lists the cash discount as a cost of maintaining receivables. Now, to an untrained eye, a discount is, a marketing expense or a sales promotion. Why on earth is the finance department categorizing a discount as a cost of accounts receivable?
Because you're really touching on the core financial engineering of trade credit here. A cash discount is a calculated cost that you incur to manipulate the behavior of your customer.
Okay, break that down for me.
Let's say your standard terms dictate that the invoice must be paid in 30 days. You go to your customer and offer a proposition. You say, if you pay me within 10 days, I will deduct 2% from the total invoice.
So you are intentionally shrinking your own profit margin. You are voluntarily taking a loss.
Yes.
Why intentionally take the loss? Is it to avoid the other four costs we just talked about?
Well, that is the precise calculus. By accepting a known quantifiable cost, that 2% discount, you get your cash 20 days early.
No, I see. So you drastically reduce your financing costs because you can pay down your own bank loans faster.
Right. You completely eliminate the risk of bad debt on that specific invoice because the cash is already secure in your bank.
And you free up that capital to put it back to work, mitigating your opportunity cost.
You got it. The financial manager is simply weighing the cost of the discount against the combined costs of waiting.
That is brilliant. So if extending credit is this treacherous laden with administrative bloat, financing charges, and default risk, the primary objective of management cannot just be to blindly increase sales volume.
No, a massive sales division is completely worthless if the credit terms wipe out the margin.
Right.
The overarching goal has to be the maximization of overall returns on investment. When a firm creates a receivable, they are making an investment.
And the management of receivables is that delicate process of optimizing the return on that specific locked-up investment. You're trying to find this perfect equilibrium.
Which brings us to the actual playbook. How does a CFO or a credit committee build the rules of the game?
They have to formulate a corporate credit policy. And the source text frames this as a hunt for the optimum sweet spot. It places two extreme philosophies on opposite ends of a spectrum.
Right. On one side, you have the loose or expansive credit policy.
Okay, so a firm deploying a loose policy will grant credit very liberally. They're basically opening the floodgates.
Yeah, they will extend terms to customers with unproven track records, limited operating history, maybe even doubtful creditworthiness.
I can hear an aggressive startup founder arguing for this right now.
Hmm.
The logic is usually tied to blitz scaling.
Oh, for sure.
Like if you're a new software as a service company or you're trying to capture market share in a highly commoditized industry, isn't any sale a good sale?
That's the argument.
If lowering the barrier to entry brings in this massive wave of new user adoption and top-line revenue, why wouldn't you embrace a loose policy?
Because that argument sounds brilliant in a pitch deck, but it often leads to a very specific, lethal phenomenon in corporate finance known as growing broke.
Growing broke? Wow. Walk us through how that actually happens.
Well, yes, your top-line revenue will look astronomical, but let's apply the costs we just discussed. If you extend credit to anyone with a pulse, your bad debt losses will surge.
Right, because half of them won't pay.
Exactly. And your administrative costs will explode because your team is suddenly spending thousands of hours calling delinquent accounts.
And meanwhile, your financing costs are draining your treasury because you have to borrow heavily to fund the fulfillment of those orders while you wait for these unreliable customers to pay.
Precisely. You can have record-breaking sales and still trigger a catastrophic liquidity crisis.
So the reactionary move then would be to swing to the opposite extreme, right? The tight or restrictive credit policy.
Right. Under a tight policy, the vetting process is draconian. The firm only sells on credit to customers who have an impeccable proven track record.
We're talking blue chip companies, government entities, firms with massive collateral.
Exactly. The lowest possible risk.
The upside there is pretty clear. You essentially eradicate bad debt. Your financing costs are highly predictable, and your admin overhead is minimal because these clients just pay automatically on day 30.
But you are suffocating your own growth.
Because by demanding perfection, you're rejecting a massive swath of the market.
Yeah, businesses that might be slightly less established but are still perfectly capable of paying, you're literally handing that market share directly to your competitors.
Which means neither extreme is sustainable for long-term corporate health. You have these two fundamentally conflicting objectives.
Right. You need liquidity, the cash to survive,
Yeah.
which pulls you toward a strict policy. But you also need profitability and the sales volume to thrive, which pulls you toward a liberal policy.
So the financial manager has to construct an optimum credit policy. The source text actually provides a conceptual graph to visualize this, and I think it's crucial for you, the listener, to lock this image into your mind.
It really helps clarify the math.
So imagine a standard chart. Your horizontal x-axis represents your credit policy. The far left side is strict, and as you move to the right, it becomes increasingly liberal.
Now we plot two distinct curves on this chart. The first curve represents your risk level. When you're on the far left, the strict end, your risk is basically zero.
Okay.
But as you move to the right, relaxing your standards, that risk curve begins to slope upwards, eventually accelerating exponentially as you start accepting highly dubious customers.
Okay, I can visualize that risk curve swooping up from left to right. What is the second curve doing?
The second curve is your security and liquidity level.
Mhm.
On the far left, you are highly secure and highly liquid because almost all your transactions are cash or guaranteed blue chip credit. But as you move to the right, adopting a more liberal stance, your cash gets tied up in increasingly risky receivables. Therefore, the security and liquidity curve slopes firmly downward from left to right.
So the risk curve goes up, the liquidity curve goes down, and they form an X right in the middle of the graph.
The exact intersection of those two curves is the holy grail. That is the optimum level.
It's a precise mathematical point where the incremental profit generated by accepting one more slightly riskier customer perfectly equals the incremental cost of the bad debt and administration required to manage them.
Exactly. It's a beautiful theory.
It is brilliant in theory, but, a graph is just a theoretical framework. How does a financial manager actually operationalize that? How do you look a prospective client in the eye and determine exactly where they fall on that curve?
Well, to find that optimum point in reality, management has to manipulate three key variables: credit standards, credit terms, and collection policy.
Okay, let's look at the first filter then, credit standards and analysis. The standards are basically the minimum criteria a firm establishes to shortlist customers. It's the velvet rope outside the club.
That's a great analogy. But you can't simply guess who deserves to get past the rope. You need rigorous, objective data.
So where does a corporate credit analyst source this intelligence? Let's say a new business approaches them asking for $1 million credit line.
The source material outlines 4 primary avenues for gathering intelligence. First, you go straight to the source and demand their financial statements. You want their audited balance sheets and income statements.
What are they looking for in those?
Analysts will calculate liquidity ratios, leverage ratios, and operating margins to really stress test the prospect's financial foundation.
Got it. What's the second avenue?
Second, you pull third-party credit reports.
Wait, we're not talking about consumer credit scores here, right? This isn't a FICO score for a person.
No, correct. These are institutional credit reports from massive data aggregators like Dun & Bradstreet, Experian, or Equifax. These organizations track the payment behavior of millions of businesses.
Oh, wow.
Yeah, they provide a comprehensive report detailing whether this specific company has a history of paying its other vendors late or if they have outstanding tax liens. It's a historical behavioral profile.
Okay, and the text also mentions bank references. How does that work?
Yes, a firm can ask the prospective customer's bank to provide a reference. Now, while banks are bound by confidentiality, they can often provide standardized insights into the general average cash balances maintained by the firm.
Right, like they generally keep mid-six figures in the account.
Exactly, or whether they've ever defaulted on a commercial loan with that bank.
Okay, and the fourth?
Finally, the most heavily weighted piece of data is the customer's past payment history with your own firm. If they've been buying from you on strict terms for 2 years and have never missed a payment, that empirical data overrides almost everything else.
Okay, so the analyst gathers the audited financials, the Dun & Bradstreet report, and the bank references. Now they have a mountain of raw data. How do they actually synthesize it?
This introduces a framework that every MBA student needs to have permanently etched into their brain: the 5 C's of credit.
Yes, the 5 C's. This is classic. They are character, capacity, capital, collateral, and conditions. But let's really break these down, not just as, textbook definitions, but how they apply in a high-stakes B2B scenario.
Okay, let's do a hypothetical. Let's imagine we are a Tier 1 auto parts manufacturer and a mid-sized, rapidly growing electric vehicle startup wants to buy $50 million worth of our components on 60-day credit terms.
Oh, that is a perfect high-risk, high-reward scenario. Let's run them through the 5 C's. The first is character. The text defines this as the customer's willingness to meet their credit obligations. So how do we assess the character of an EV startup?
We look at the executive team and the board of directors. You see, character in corporate finance isn't just about moral fiber. It's about historical integrity and management philosophy.
Like, what's their track record?
Exactly. Have these founders been involved in previous bankruptcies where they just left suppliers holding the bag? Does the Dun & Bradstreet report show a pattern of aggressively disputing invoices just to delay payment?
Ah, so using disputes as a stall tactic.
Right. If the management team views vendors as partners, their character is strong. If they view vendors as a free source of leverage to be exploited, their character is fundamentally flawed. And listen, if character is weak, the other 4 C's do not matter. You reject the application.
Period. Okay, assuming their character passes the test, we move to the second C, capacity. This is defined as the ability to meet obligations out of operating cash flows.
This is where we tear into their income statement. The EV startup might have a brilliant product and honest founders, but do they actually generate enough cash from selling cars to pay for the $50 million in parts we're giving them?
So you're looking at their EBITDA.
Yes, earnings before interest, taxes, depreciation, and amortization. If their burn rate is astronomical and their operating cash flow is deeply negative, they simply lack the mathematical capacity to pay us back in 60 days, regardless of their good intentions.
But wait, what if they have VC backing? Like, what if they just raised a ton of money? That brings us to the third C, right? Capital. Capital represents the financial reserves of the firm.
Exactly. Let's say their operating cash flow is currently negative because they're scaling. We then look at their balance sheet equity. Have they just raised $1 billion in Series C funding? Do they have massive cash reserves sitting in short-term investments?
So capital acts as the shock absorber.
Right. If their primary capacity, their operating revenue stalls out due to a production delay, their capital is the reserve tank they will drain to ensure we still get paid. A heavily leveraged company with minimal equity has terrible capital and poses a massive risk.
Makes total sense. The fourth C is collateral. This is a pledged asset in the case of default. If their cash flow dries up and their VC funding runs out, what is our downside protection? Collateral is the tangible asset we can legally seize and liquidate to make ourselves whole. For the EV startup, maybe we structure the agreement so that our credit is secured against their proprietary manufacturing equipment or the physical real estate of their gigafactory.
Wow, okay.
If they default, we take the factory. It's the ultimate fail-safe for the creditor.
Finally, we evaluate conditions. This refers to general economic conditions entirely outside the control of the borrower.
We have to zoom out and look at the macroeconomic environment. The EV startup might have great management, solid funding, and a state-of-the-art factory. But what if there's a sudden global shortage of lithium, halting all EV production worldwide?
Or what if interest rates spike to 15% and consumer demand for auto loans just dies?
Exactly. These external conditions can instantly destroy a company's ability to fulfill its credit obligations, no matter how strong the first four C's are.
Character, capacity, capital, collateral conditions.
Mm-hmm.
So the analyst synthesizes all this and often uses credit scoring to assign a mathematical weight to each parameter, creating an objective score. Right. And based on this score, accounts generally fall into three categories: good, marginal, or bad.
Good accounts are approved immediately. Bad accounts are rejected outright.
But the marginal accounts, that middle bucket, that is where the true strategic battles are fought. Managing marginal accounts requires an incredibly high level of financial acumen.
Because if you just reject every marginal account, your sales team is going to revolt. You are leaving millions of dollars of potential revenue on the table.
And if you approve them recklessly, your bad debt spirals out of control. The art of corporate finance is finding ways to safely say yes to a marginal client.
How do you do that safely?
You mitigate the risk by manipulating the terms. Maybe you demand higher collateral. Maybe you offer them a much smaller initial credit limit to test their behavior. Or maybe you manipulate the second major variable of your credit policy, the credit terms.
Let's dive into credit terms. Once you approve the customer, you establish the rules of the transaction. The most basic component is the credit period. Are you giving them 15, 30, or 60 days to pay? But the real strategic weapon hidden in the terms is the cash discount. We discussed it earlier as a cost, but let's break down the actual mechanics. The text uses a very standard B2B example, 210 net 30. It's usually written on invoices as 210 net 30. How should an MBA student interpret that?
It is a specific contractual offer. Net 30 establishes the baseline. The full legally binding payment is due within 30 days of the invoice date.
Okay.
The 210 is the incentive structure. It dictates that if the buyer remits payment within 10 days, they are authorized to deduct a 2% discount from the gross invoice amount.
Now, 2% sounds negligible. If a procurement manager is looking at a $100,000 invoice, they save $2,000. Why would a massive corporation care about a 2% variance?
Because you cannot look at it as a flat percentage. You must evaluate it through the lens of annualized interest. This is a vital calculation for anyone in finance. The buyer is being offered a 2% guaranteed return simply for advancing their payment by 20 days.
Right, because they had to pay by day 30 anyway, so they're just paying 20 days early. Let's really do the math on that. If I earn 2% over a 20-day period, how many 20-day periods are in a 365-day year?
Roughly 18.25.
So if I compound that 2% return 18 times over the course of a year, the effective annual interest rate is astonishing.
It is approximately 36.7%.
36.7%.
There is virtually no legal, risk-free investment in the global market that yields a 36.7% annualized return.
That is insane.
Therefore, from the buyer's perspective, if their own cost of capital, say, drawing from their revolving credit line is only 6% or 8%, it is an absolute financial imperative to borrow money at 8% from the bank in order to capture a 36.7% yield from their supplier.
A competent CFO will mandate that their procurement team takes the 210 discount every single time.
Exactly. And from the seller's perspective, you are fully aware you are paying an exorbitant annualized rate to get that cash 20 days early.
But you do it because securing the cash today might be the only way to fund your own next production cycle.
Right, and it completely removes the default risk of that specific client. It's a masterclass in liquidity management.
Okay, but what happens when the brilliant terms fail? You analyze the 5 C's perfectly, you offer a lucrative cash discount, and yet day 30 comes and goes, day 45 arrives, the invoice is just sitting unpaid.
This forces the financial manager to pull the third lever of the credit policy, the collection policy.
Because a company can have brilliant sales and brilliant analysts, but if they cannot collect the cash, they die.
Simple as that.
The source text outlines a 4-step escalation for collections. And what really stands out to me here is the psychological friction involved in each step. You are constantly balancing the need to recover your money against the risk of destroying a lucrative long-term business relationship.
That tension defines the entire collection process. Step 1 is sending a delinquency letter,
which is pretty standard.
Yeah, this is intentionally low friction. It is a formal written notice simply stating that the account is past due. It provides the customer with a graceful exit.
It assumes administrative error, basically. Like, perhaps your accounts payable software had a glitch, or the invoice was routed to the wrong department.
Exactly. It prompts action without leveling an accusation.
But if day 60 rolls around and the letter is ignored, you move to step 2. The telephone call. The dynamic changes entirely here.
Oh, the friction increases significantly. A letter is asynchronous. It can be ignored or buried in an inbox. A phone call forces a real-time human confrontation.
Right.
The customer's accounts payable manager has to verbally explain the delinquency to your collections officer. It strips away the anonymity.
That's got to be uncomfortable.
It is.
Yeah.
But a highly skilled collections team uses this call not just to demand payment, but to gather intelligence. Why are they late? Did their biggest client just go bankrupt? Are they experiencing a temporary cash crunch?
So if the relationship is valuable, the seller might use this call to negotiate a restructured payment plan to keep the customer alive.
Exactly. You want the cash, but you also want the future business if they can be saved.
But if the phone call yields nothing but empty promises, we cross a major threshold. Step 3. Employing a collection agency. This feels like the point of no return for the relationship.
It absolutely is. When you hand an account to a third-party collection agency, you are officially declaring that the partnership is over. You are transitioning them from a customer to a debtor.
Wow.
The agency specializes purely in asset recovery, often using highly aggressive tactics.
Yeah.
And remember the collection charges we discussed earlier.
Oh, right. The administrative costs.
These agencies take a massive cut, sometimes 20% to 40% of whatever they recover. You are sacrificing a huge portion of your revenue and incinerating the relationship just to salvage a fraction of the cash.
Which leaves step 4 as the ultimate scorched earth option, legal action.
Initiating a lawsuit is the absolute last resort. The legal fees are astronomical, the process can take years, and even if a judge rules in your favor, a judgment is just a piece of paper.
Right. If the customer is truly bankrupt, there might be no assets left to seize anyway.
You only escalate to legal action if the principal balance is massive and your intelligence confirms the company actually has the liquid capital but is simply refusing to pay.
To manage this entire escalation efficiently, a financial manager relies on a specific reporting tool mentioned in the text, the aging schedule. I mean, if an MBA student is ever tasked with auditing a company's receivable risk, asking for the aging schedule is step 1.
Yes. An aging schedule breaks down the total aggregate accounts receivable balance into distinct time buckets.
Yeah.
It doesn't just show that you're owed $5 million in total.
Right. It gives you granularity.
It shows that $3 million is current, $1 million is 60 days past due, and $500,000 is over 120 days past due.
So it provides a risk heat map.
Exactly. A balance that is 15 days late might just need a gentle letter. A massive balance that hits the 120-day bucket triggers alarm bells at the CFO level, signaling a high probability of bad debt that requires immediate aggressive intervention.
Okay, so we've built this massive structured apparatus. We have the optimum policy, the 5 C's analysis, the strategic discount terms, and the aging schedules. But let's look at the dark underbelly of working capital.
Let's hear it.
Let's imagine a scenario where you have executed this framework perfectly. Your customers are highly rated, they are within their 60-day terms, and your aging schedule is clean.
Sounds great so far.
But you are a manufacturing firm growing at 300% year over year. You need to buy raw materials tomorrow to fulfill a massive new order, but all your cash is locked up in those perfectly healthy 60-day receivables.
Classic hypergrowth cash crunch.
You cannot wait. You will miss the order. What is the emergency valve?
This introduces a critical and often misunderstood instrument of corporate finance, factoring. It is the ultimate shortcut to liquidity.
The source defines factoring as a financial transaction where a firm sells its accounts receivable to a specialized third party, the factor, at a discount. Now, I want to challenge this concept because from a traditional margin preservation standpoint, it seems incredibly destructive.
How so?
Well, you have already incurred the cost of goods sold, the marketing cost, the admin cost. Why would a healthy, growing company voluntarily sell an invoice for less than its face value and voluntarily destroy their net profit margin?
Because in periods of hypergrowth or severe cash crunches, liquidity supersedes profitability. Factoring is a lifeline. Let's run the scenario.
Okay.
You hold a $500,000 invoice due in 60 days from a blue-chip client. That is a guaranteed payment eventually. But you need $400,000 today to meet payroll and buy materials for an even larger contract.
Right.
You take that invoice to a factoring firm, often operating the shadow banking sector. The factor agrees to buy the invoice today. They'd advance you $475,000 immediately.
Okay, so I take a $25,000 haircut.
Yes. When the 60 days are up, the factor collects the full $500,000 directly from your blue-chip client. That $25,000 spread is the factor's profit, and it is the price you pay for instantaneous cash flow.
You are literally trading a slice of your profitability for the ability to operate today. It completely short-circuits the working capital cycle.
Exactly.
But there is a massive structural variable here regarding risk. If I sell the invoice to the factor and my previously reliable customer suddenly files for bankruptcy on day 59, who absorbs the loss? Does the factor take the hit, or does it bounce back to me?
That exact question defines the two distinct categories of this instrument: recourse factoring and non-recourse factoring. It completely alters the risk profile of the transaction.
Okay, break down recourse factoring first.
In recourse factoring, the original seller retains the ultimate credit risk. The factor is essentially providing a highly structured, secured advance against the invoice, and they take over the administrative burden of collection.
But if the customer defaults...
If the invoice matures and the customer defaults, the factoring company exercises their recourse. They pivot back to the original seller and legally demand the return of the advanced funds.
Oh, wow. So the factor acts as a financier and a collection agency, but they are absolutely not an insurance policy. If the debt goes bad, the original business still suffers the bad debt write-off, plus they have paid the factor's fees.
Precisely. Because the factor is not absorbing the default risk, the discount rate, the fee they charge the seller, is relatively low. It is a cheap way to accelerate cash flow if you are absolutely certain your customers will pay.
But if you want to completely sever your ties to the risk, you opt for non-recourse factoring.
Yes. In non-recourse factoring, you are selling both the invoice and the risk. The factor assumes 100% of the default risk. If the customer goes bankrupt, the factoring company takes the total loss. They have no legal mechanism to demand the money back from the original seller.
That sounds like a dream scenario for a CFO trying to clean up a balance sheet. You get immediate liquidity and you completely immunize your firm against bad debt.
It's powerful.
The catch has to be the pricing, right?
The catch is steep. Because the factoring firm is absorbing all that risk, they have to price it into the transaction. They charge a standard fee for the cash advance and the administration, but they add a highly specific premium charge known as the del credere commission.
Del credere. It sounds like a term pulled straight out of Renaissance-era Venetian banking.
And its roots actually do trace back to early European merchant banking. It roughly translates to a guarantee of solvency. In modern corporate finance, the del credere commission is effectively an insurance premium. The seller is paying the factor to insure the invoice against default.
So a financial manager has to perform a rigorous cost-benefit analysis. Is it worth paying a massive del credere commission to eliminate risk entirely, or do we use cheaper recourse factoring and trust our own internal 5Cs analysis? It always comes back to calculating the trade-offs.
Exactly. Every decision in receivable management, from setting the initial credit standard to offering a 210 net 30 discount to choosing between recourse and non-recourse factoring, is a calculated trade-off between the desire for growth and the absolute necessity of liquidity.
We have unpacked a tremendous amount of structural theory today. For the MBA listeners out there, let's just quickly synthesize the core journey. We began by dismantling the illusion that trade credit is a free courtesy, exposing the heavy opportunity costs and financing burdens hidden beneath the surface.
Right.
We visualized the razor's edge of the optimum credit policy, finding the exact intersection where the risk of liberal terms balances against the lost revenue of strict terms. We operated as credit analysts, running prospective clients through the gauntlet of the 5Cs: character, capacity, capital, collateral, and conditions.
And we translated the immense annualized power of the cash discount.
We mapped the psychological escalation of the collection process, and finally, we examined factoring as the ultimate lever to convert paper promises into immediate, actionable capital.
The advantage you have now is that you don't just know the vocabulary. You understand the profound mechanical tension underneath the income statement. You recognize that managing receivables isn't just an administrative afterthought. It is often the deciding factor in whether a business scales successfully or collapses under the weight of its own uncollected revenue.
That structural understanding is what separates an average manager from a true strategic leader. But before we wrap up, I want to leave you with a provocation to ponder something that isn't in the textbook yet, but will absolutely define the next decade of corporate finance.
I love it, this part.
We just spent this entire session analyzing the incredibly complex, expensive infrastructure businesses have built just to manage the reality of waiting 30 or 60 days to get paid. The 5Cs, the collection agencies, the massive factoring, it all exists because of the delay inherent in the trade credit economy. But look at the technological landscape accelerating around us. We are seeing the rise of enterprise blockchain architecture, smart contracts that can execute programmable money the exact second a GPS sensor confirms a shipment has hit a loading dock, and instantaneous global digital payment networks. The technological friction of moving money has essentially dropped to zero. Cash settlement can theoretically happen in milliseconds globally.
It's a completely different paradigm.
So as you prepare to enter these boardrooms, consider this. In the future of corporate finance, will the entire concept of B2B trade credit completely collapse as instant settlement becomes the default norm? Or will waiting 60 days to pay simply evolve from a logistical necessity into a sheer luxury perk, a massive power move reserved only for the most dominant corporate giants who can force their suppliers to finance them? Keep that tension in mind the next time you audit a balance sheet. Until next time.